All right. Welcome, everyone, to the long and short of it. Another episode I'm looking forward to here. I'm Patrick Ceresna.
And I'm Nick Galarnik.
All right, buddy. Let's dive right into it. We already a couple episodes in. We started off like a month ago talking about Google, and since then the quantum computing thing just started gunning everything. And I think it's worth talking because obviously at one point the as the first gaps happened, the Google trade was up considerably, and we demonstrated profit taking a number of the contracts when we were up there, but the Google hasn't quit. So why don't you talk us through, what you were thinking and how you're viewing this Google trade now?
Yeah, so Google overshot all three legs. If you recall, we had the 170, 180, 190 butterfly call spreads, right, and Google shot up to over $200 per share, hitting new all-time highs after the news on quantum computing. So what happened there was that the position ended up trading down after we cut part of our position to a low of about $1.30 or so. But on Friday, the market opened up down overall, and Google dropped down to 186. So right at open on Friday, which is the expiration date of this trade, it was trading at $4 and change. So if you had the trade open, you could have closed it for $4 and change. Obviously, Google ran all day to about 193.50 or so. It expired worthless. But the whole idea is that with these short-term trades, they're actively managed, which is why they're not for everyone, right? People that are managing their portfolios actively, they can be sitting in front of a screen all day, every day, and watching the markets like a hawk, but not everyone can do that. So ultimately, they expired worthless, but they were trading at $4 prior to that. And given that we de-risked the position, it overall was profitable.
Yeah, absolutely. And so let's then talk about a couple of weeks ago, we were talking about how cheap portfolio insurance was.
Yeah.
And one of the interesting things here, I have a chart here of the S&P 500. One of the things that while we were recording that, we went through the gamma pinning, which was this extended period where that huge open interest of 42,000 contracts of the call options up at the 6,055 strike kept the markets pinned into an incredibly tight range. And it was crazy from a dispersion perspective because you actually, under the surface of the index, had extraordinary volatility of the individual components. You had the Mag 7s ripping like nobody's business, this huge bull market and all these mags running higher. And to create an offset, so much of the underpinning market was just getting its face ripped off, and was selling so aggressively to some of the most extreme oversold conditions. Like when we were up here with the S&P trading near its all-time high, on that drop day, we reached a point where the market was so oversold that only 20% of stocks on the S&P 500 were actually above their 50-day moving averages. That means 80% of stocks in the S&P make up the S&P 500 were downtrending. Devastating drops in energy and healthcare and so many of these other spaces. Home builders rolled over. Semiconductors have been so weak. Every single one of these spaces was just getting killed. It's really amazing that the index itself looked like there was nothing going on. But here we are. See, this is the 23rd of December. We're just days before Christmas and the year end. And a lot of these factors, I mean, maybe we're going to have markets quiet, maybe rally a little bit more in the next week or two. But boy, is it going to be interesting going into the new year. And it'll be really interesting to see whether the incredibly oversold stocks will actually have a rally or whether the Mag 7s go through a profit-taking cycle and potentially spur the first kind of big and meaningful market correction that has arguably been long overdue in the markets. What are your thoughts?
Yeah, so I mean, with this trade in particular, the one we mentioned for the March OPEX, it already doubled in value at the lows of the market. So if, for example, as we mentioned with the whole idea of de-risking and strategies, if, for example, you wanted free insurance, let's say you bought more than one position, you could have, in theory, cut one position and it would have been free because you would have doubled your money on one contract. So you would have had free insurance. essentially 100 points wide, which gives you about 10K of upside with $0 risk on the downside. That being said, like discussing the overall market trend ahead, I do think we see some turbulence into Trump's inauguration, because I think right now we're seeing a lot of push to the upside without profit taking occurring, because it's been such a great year overall. But once the calendar rolls around, I see a lot of profit taking occurring because Trump's presidency will probably bring about a lot more volatility than Biden's, given that many random events come out of left field pretty often, as we saw in his previous term.
No.
And that's kind of where market participants don't like to see the unknown coming about very, very often. Like he's already mentioned the last week wanting to take over the Panama Canal. He's made jokes about taking over Canada. Like these are all kind of tongue in cheek, perhaps, and maybe he's joking, but nonetheless, market participants don't like when they hear that kind of stuff, right?
Well, I think those are factors. If there was going to be a sell-off in the market, I think it has a lot to do with the overstretched conditions and the market being slightly overdue. I mean, certainly the FOMC certainly threw a bucket of cold water on those that were overly dovish, thinking that the Fed was going to be there to accommodate, and so a lot of the frothy valuations may have to be more realistically reined in, and that could just lead to some degree of a profit-taking cycle. And it's great to be hedged. I know that you referencing the idea of making a hedge costless and taking some profits, and that the trade-off, of course, is how you size the trade in the first place. If you were over-hedged to some degree or another, paring it off to make it a zero-cost carry is always a beneficial thing. But if you sized the trade in a manner that was hedging actual real assets,
your portfolio,
then spending that 1% to carry the hedge is the trade-off of having that downside tail risk completely removed, and so that's the big debate as to whether you profit take a little bit and mess around with it and gaming it this way back and forth, or whether you hold that insurance moving forward. But listen, Nick, let's jump right into a new trade idea. Like it's your turn this week. So, what are you thinking? What stock do you want to feature? Let's dive into it, buddy.
So I had a couple of ideas that I wanted to discuss, but I pinpointed one that I like a lot, which is AMD, Advanced Micro Devices. The stock right now is down over the last, since October 9th, their high. They're down about 37% at the low. And from their all-time high, which was attained back on March the 8th, 2024, at 221 roughly, they are down now 48%. So on the longer term time frame, they are pretty much flat over the past few years. I think they're actually down over the past couple of years right now. And to me, that means that they've been making a lot of progress overall. The market hasn't really recognized that overall. And a lot of these participants in the semi industry, like namely NVIDIA and Broadcom, have done very, very well in the AI space, which is not really AMD's bread and butter. However, AMD has gone into that space, and over the last year, they've generated $5 billion in revenues. Now, we've seen analyst downgrades the past few weeks overall, which to me is a sign that we're nearing a bottom. Because what I've noticed over the years of trading is that we tend to see analyst downgrades come about before a bottom occurs, typically spurring buying on the low prices. And retail investors tend to sell off at lows, thinking that's going to go lower perhaps and break support and head lower. And usually what happens is that it reverses in a very, very sharp fashion and pops to the upside. And when that occurs, that's where you want to be, buying the fear essentially, especially when nothing fundamentally has changed with the company. In this case, we have no actual fundamental proof that anything has changed with the company overall. They're performing better than they were 2 years ago. And they're further along now with their AI chip, which is now, it'll take up probably a small market share of overall NVIDIA's space. Like even if they can grab, 5-10% of NVIDIA's market share, that's a big piece of the pie overall right now. And keep in mind that they're worth about 1/15 or so NVIDIA's market cap. That aside though, overall, they're right now, I think, oversold. So in the short term, the implied move for the February OPEX, which factors in the earning report toward the end of January, This implied move is about 20 points from the current price of about 125. Today they're up about $6. They bottomed out on Friday at about 118 or so. And this could be the bottom right here where it might push up toward around like 150 again. And as we've seen it in the past, it moves very, very fast off these lows. Like we've seen moves from, 122 to 170 in the span of a few weeks, right?
Absolutely. Absolutely. Let me just actually show you. First of all,
Yeah.
I do like your 150 level because after such a very distinct downtrend since October, typically a bounce usually gains back about 50% of its losses. So after seeing, a $56 drop, expecting a $25-$30 bounce is very typical. And so, from here, getting back to 150 is a very typical retracement. To kind of show the magnitude of this, you can see back in August after that low, this rally only took like 2 weeks. And from its trough to peak, we were talking about a $40 rise that literally happened in the span of 2 weeks. Point is that wasn't a new bull market. That wasn't a new major trend. It was simply a very oversold market that was due for a bounce. And when it bounced, it just ripped, causing short sellers to cover. People that are watching it for a technical signal go rushing back in, and suddenly your flows shift and the stock rallies. And so it's not out of line for us to see that. So I don't have any issues with your call. I think this is pretty interesting. So let's talk about how you would implement something. Like what would be your best strategy, or one ways that you could approach playing this kind of a bounce?
So, I mean, like given that options offer you really like infinite numbers of permutations on how to play a given thesis, you really got to narrow down what the best idea is based on your risk reward, asymmetry of risk, right? And looking at the different ways you can play it. You can buy the stock right now, for example, 125. If your target's 150 over the next couple months, your upside there is what? It's 1 over 5, 20%. But then you're risking 12.5K for 100 shares, for example. If you buy a call option, you could buy a call option in the money right now. It costs about $10 or so. So you're risking about, $1,000 or so. Upside would be roughly $2,000. So two units of reward per unit of risk. The trade that I like right now, shorter term, which is for February OPEX, would be the February OPEX 130 to 150 bull call spread. And right now, the cost is approximately $5.30. So you'd be risking $5.30 to make $14.70. So almost 3 units of reward per unit of risk. And with this in mind as well, this factors in the earning event, which occurs toward the end of January. And so what will happen is that come the earnings, we'll find out if these analysts were correct or if they were incorrect in their overall downgrade of the stock. And what this reminds me of a little bit is Micron, which was downgraded during the summertime, trading near lows. They went from about $100 down to $85 or so on downgrades. They then beat earnings in September and took off like a rocket to 114 after earnings. They sold off right after that toward $100 again. But the point is that you wouldn't hang on to this trade for like a long time. You would wait for the bounce to occur and then divest of your position. Not to mention that you could have stop losses built in. So for example, in this position, you could stop out at, for example, like $2 and say if AMD breaks down below 115, I'm out. That's probably the pocket area where you want to go long term. Hence the term, hence our show title, the long and short of it, right? So we have the short term way of playing this, which is February OPEX, 130, 150 call spreads for $5 and change right now to make about $14.70 roughly per contract. So about 3-to-1 risk reward to risk. And then what you do is that you wait till after earnings occur, confirm that everything's all hunky-dory with AMD overall, and the management reaffirms guidance. At which point, if they pop up to 150, you're making 300% return on your trade anyway. If, however, they decline down to like 115, 110, $100, that's where you got to look at, for one, was the information in the earning report conducive to a bullish thesis longer term? If it was, and they sold off on an EPS beat, a revenue beat, and a guidance inline or raise perhaps, that's a time where you want to go longer term, where you look at, for example, a stock replacement strategy, buying as an example, the 100 strike call options. Right now they're about $40. So you'd be paying about $4,000 for exposure to a position that would give you, buying, owning 100 shares would be equivalent to owning or 12.5K worth of stock, essentially.
So Nick, let's go backwards for a second, because I love this idea of this long-term option you're talking about, and I think what we should do is divide and conquer this thought exercise. First, let's go back to the debit spread, and just let's kind of dig a little bit deeper as to why our listeners should consider debit spreads and the trade-offs of using a debit spread versus that of, let's say, going long gamma, which is just simply buying a call option. And so in this situation, the one that you illustrated allows you to reduce the cost from $8.50 for this option to basically $5.
Yes.
You were able to reduce the cost. So instead of outlaying $850 for each contract, you're outlaying only $500. So immediately, the one benefit is less capital at risk. Yes. Right? You're outlaying less, and therefore less risk. And so therefore, many times, a lot of investors that turn to debit spreads often do so to size their risk, particularly smaller traders, because when let's say you have a very popular stock that's trading at $500 or $1,000 a share, to go and just buy a call option on these might be $20, $30. And so therefore, your starting point is outlaying $2,000 to $3,000. If you're a smaller trader, let's say dicking around with $10,000 in an account, you outlaying that kind of money as a risk outlay may not fit your trade plan. Like your risk sizing may be too large. This is where a lot of smaller account traders say, well, I just want to participate in a sliver of the upside on these stocks. And by, let's say, having a spread between a certain buy and sell point, I can, instead of outlaying $2,000 or $3,000, just like this trade, I might only have to outlay $500.
Correct.
And so it is an amazing strategy for a lot of smaller traders to be able to implement these trades in a very clear bias to it. But the one thing I want to highlight is, let's debate going along a call option versus a debit spread. And the first and most evident thing is the rate of time decay. Yes. When you are long a call option purely, you have all this explosive gamma. Like if you start being right away and this thing starts ripping, except no substitute. If you're the most immediately bullish right now and you think that this thing is just going to rip higher, there's no point in doing it as a spread. Like you just buy this option and let it rip. And that is immediate benefit of the convexity of that option working your favor. But when you open it as a spread, it helps with the carry cost. In the case of this trade, you're talking about, let's say, the first 7 to 10 days of this trade, your theta burn or time decay is actually not far from zero. Because whatever you're losing in time decay on this $8 $130 call $8 130 strike call option, you're pretty much offset with the short option, time decaying in a similar manner. And so in the early stages where you're trying to discover if the stock is turned, you're not getting hammered heavily in a carry cost. And that is certainly one of the things that I think is a huge plus for a debit spread, is that when you are uncertain of the timing or whether this is the turn, that debit spread allows you to have a lot more forgiveness from a time decay perspective in the carry.
Absolutely, yeah. I mean, it's all about really capital efficiency and asymmetry of risk. And as you said about the point on, buying the call option on its own for $850, just from my perspective, right? If I'm buying that call option on its own and I want the same upside as the call spread, which offers me 300% upside overall, assuming that AMD goes above $150 per share come the February 21st monthly OPEX, in order for me to achieve the same return on that call option of 300%, I need to make three times 850 plus my additional debit cost of $8.50. So that's about $34 overall from the 130 strike, which means that my overall attainment of 300% return would lay somewhere around 164 per share on AMD. Now contrast that with the call spread where you're making the same percentage return, but only at 150. So you require a 10% less pump in the stock price to achieve the same percentage gains using the spreads, not to mention, as you said, the diminishing time decay on the position, because right now the time decay or theta on the 130 call option is about 9.5 cents per day, meaning that all else remaining equal, this position will lose about 9.5 cents on that contract per day. However, by using the spread, the 150 strike, which you're selling, would incur 7 cents of time decay per day. So you're reducing your time decay from 9.5 cents to 2.5 cents per day, which is a substantial reduction in risk overall. Not to mention your break-even cost goes from 138.50 roughly down to 135, right? So like the way you got to kind of think about each and every incremental trade is that it's a chess move you're making in the game of chess, which is the market essentially. And each move you make, either you're going to win or lose. And after that move is done, you then move on to the following move and figure out what you're going to do next, right? So, but as I said previously, sizing for these trades should be done very thoughtfully and very carefully. You never want to go all in, for example, even if you're managing a smaller account, you want to keep it so that if you're are wrong, and keep in mind, a lot of traders, even good ones, are wrong pretty often, you don't want to lose that much money, which is why I said, if it breaks down, for example, toward like 115, 110-ish and trades at like $2, I'd probably stop out and recalibrate my position, because at that point, if it pulls too far away from the strike price and time decay becomes a factor and we start getting toward that expiration date, you don't want to be hanging on to it, hoping for it to pop to, 130 to break even again or so. When it's like, 110 per share, at that point, maybe you want to go with the 120, 140 or the 115, 135. Adjustments can be made incrementally depending on what makes the most sense at the time. And yeah.
The one little thing that it just needs to be clarified, though, when you're looking at the payoff profile at end, which is what you're looking for a 3-to-1 payoff, that is at its expiration. Yes. And one of the downfalls of a debit spread is if the move happens too quickly with too much time left at the 150 strike. And so here with a February 21st expiration, if we were like January 14th, still like 5 weeks before, and AMD goes ripping $25 in 2-3 days, you're nowhere near your max full profit, 3-to-1 max profit. And that is that thing that we were referencing at the beginning, which is, yes, at end, you only needed to go to 150 to make a 3-to-1 payoff, but that's at its expiration. And if that move happens too quickly, too fast, then you're only going to attain maybe a 2-to-1 payoff or some lower payoff. And that's the trade-off. And this is the way I would always, personally, the way I would say, the more bullish you are and the more you believe this move is imminent right now and is going to be ripping, the more you can consider an outright call option. And the more that you think that it's going to be a trade over time and the trade needs to develop, it needs to move forward, the more the debit spread is a great way to express it. I love the idea. I'm dying to see how this plays out for you, Nick. But listen, okay, I'll let you make the comment, and then we got to try this long-dated one that you wanted to talk about.
Of course. So 2 points on that. So one of them is that if it does shoot up too fast, let's say, for example, next week it's at 150 a share and the spread is fully in the money, there's 2 choices then at that point in time, right? This is where you call it dynamic hedging. Nassim Taleb had an awesome book on this, which was written in the 90s. It's very, very technical, but it's a really, really great read. So if, for example, we went to like 155, we're fully in the money, but we're still so far away from expiration and we're not near maximum profit, there are 2 things you can do. One of them is take profit on your existing spread and then take some of that profit and buy a new spread at a higher strike, for example. Or 2, what you could do is you could actually sell an out-of-the-money spread of equal distance, which will offset essentially some of your debit costs. So for example, if it went to like 160 like next week, which is improbable, obviously, but it has happened before where it moves very, very fast. At that point in time, you could sell, for example, like the 170, 190 call spread for a credit of like $2, $3, which then offsets your overall debit from 5 down to 2. And now you're risking 2 to make, 18, in which case your asymmetry of risk changes from, 3 units of reward for 1 unit of risk. Now you're risking, 1 to make 9, for example, right? But again, these are kind of ways of thinking about it dynamically overall.
Absolutely. Okay, so let's talk about this long-dated in-the-money call that you wanted to talk about. So here I put up that January 2026 leap. We're basically 1 year out on this thing.
Yeah.
And now the interesting thing is AMD at this moment is trading at $125. But you wanted to talk about the $100 strike call option, which is basically giving you the right to buy the stock at $100, even though it's trading at 125. That's called an in-the-money call option.
Yes.
And what you're basically doing is literally buying an equity stake into the stock, the intrinsic value component, making the option more expensive, but that option often behaves like the stock. Why don't you explain what you're thinking here?
So the idea here is that, let's say you have 2 investors, right? You have, let's say Paul, for example, he wants to buy the AMD stock at 125. He wants to buy 100 shares. He buys $12,500 worth of stock, gives him 100 shares. Then you have, let's say, for example, John. John buys 1 call option, expires January 16th, 26, for example. He pays $4,000 for 1 contract. So his break even is the strike price plus his debit cost of 40. In this case, $100 strike price plus $40 debit cost, break even of 140, which is 15 points above the current spot price of 125. So he requires the stock to move up by about 12.5% roughly in order for it to 11%, in order to be at break even at expiration. Now, the trade-off here is that basically you're mimicking owning the stock using a fraction of the capital. So John is only using 1/3 the amount of capital to mimic owning 100 shares of AMD stock. So just think about that for a sec. If you have a smaller portfolio, basically you're controlling 12.5K of stock using $4,000. And this expires a year from now. So the risk of AMD, for example, flushing down to like $80. I mean, if the market were to crash, yes, that's a risk 100% for sure. But the nice thing is that if you were, bullish bias on a longer term, owning the stock, you would lose a lot more money on the downside than you would on the option, because the option will retain a lot of value, because as the price of the stock falls, the implied volatility rises, which actually dampens the effect of the downside. And so here you get a lot of numerous benefits. The primary one is capital efficiency, but the second one is that you get better asymmetry of risk. And if, for example, we see AMD at like $200 per share, which I think is a decent probability event next year, assuming they perform well fundamentally, this option ends up being worth $60. So you make pretty much 150% return on the option, whereas on the equity, you make about, 75 over 125 is 3 over 5, 60% overall, right? So overall, it's just a much more robust strategy. Now, the downside would be that you're paying for time premium and volatility premium in the form of the extrinsic value, which is about $15. But if AMD were to pull down to like $100 per share or $90 per share, you have that much more ammunition in dry capital to, let's say, average down your price if you still believed in the thesis overall. Right.
Now, Nick, I love this strategy. I did a whole YouTube video on it because one of the famous politicians, Nancy Pelosi, uses this strategy actively and by buying deep in the money options, which are high delta. What is a high delta, like you were alluding to earlier, means that the option actually moves very similar to the stock. So as an example, right now, if you bought 100 shares of AMD, it would be behaving like a $12,500 investment. While right now, that $100 call option you just talked about for $40 is currently behaving like $10,000 investment, or basically 80 cents on the dollar. But the convexity you were talking about is bang on. So the fact is the more this thing is right, the more it behaves like the stock, and giving you that investment, like if you wanted it, skin in the game. What I personally love about this strategy is that when smaller account traders, they tend to look for big bang on their money, which is that they're trying to lever up, and they often turn to margin. They go and borrow money on their margin accounts to buy the shares in this amount. The thing is margin is a double-edged sword. You can actually very easily during a market event get margin called, forced to liquidate these positions. But what I love about your deep in the money option is you outlaid this $4,000, but there's zero chance of margin call. And more importantly, the more that market crashes, exactly like you were saying, the more the implied rises as it's going to being at the money. And in other words, you're actually losing at a slower and slower pace the more wrong you are, and
Absolutely.
never having the risk of being margin called, while on the way up, you're participating like if it's the stock. To me, it's a win-win, a strategy that should always be considered, especially from our listeners that love to leverage. This is a great alternative to margining.
Absolutely, yeah. And one more thing to add too is that, like, if, for example, AMD were to fall to $100 per share today, a simple exercise to use to figure out how much your option would be worth is look at the current price of the spot strike call option for the same expiration date. So right now, the 125 strike call option, same expiration as I just mentioned of the $100 strike call we discussed, is at $27 right now, which means that if AMD were to fall to $100 per share, that call option we mentioned, which is $4,000 or $40 per share right now, roughly, or per contract right now, sorry, would be trading at about 27 or so, meaning that the stock price or the buyer of the stock, Paul, for example, would be down $25 per share, but John would be down $13 on his contract itself. So there's so many different benefits overall to this strategy. And I've actually mentored numerous fund managers that employ stock replacement strategies as part of their portfolio management, which in my mind is a much, much more robust way of managing long-term positions, assuming they don't pay dividends, for example, because then you're missing out on the cash flow aspect of an investment, for example.
Yeah, that's often though discounted into the option price itself on that. Nick, love the ideas, buddy. Any closing thoughts, or are we good for a wrap?
I would just say, everyone, Merry Christmas and a Happy New Year. And we'll see you all in 2025. And Patty, yeah.
Look, I'm looking forward. Listen, we started this just trying out this new podcast format, but looking forward to putting a good number of these episodes in next year. There's lots that we can share with our listener base. I hope you guys getting lots of value out of this, and happy Merry Christmas, Happy New Year, and looking forward to the next episode here with you, Nick, in the new year.
You as well, Patty. You as well.
All right. Cheers, everybody.
Cheers, guys.